Hello everyone, welcome to my lecture on Unit 5 Topic 3, Types of Ratios. The third type of a ratio that we are supposed to learn today is capital structure ratios, otherwise called as leverage ratios. Basically, we need to, before we go ahead with the discussion of this capital structure ratios, we need to understand about the capital structure and its significance for any firm. A company's capital structure is important because it indicates how well the company is financially stable and healthy. It also shows how well the company is using its funds, that is both equity and debt, to finance its operations and how flexible it is financially. So capital structure is very important it is very useful in assessing the market value, the risk and returns, financial flexibility of the firm, cost of the capital, creditworthiness of the firm, attracting more investors or the new investors, and it also showcases the sustainability or sustainable growth of the firm. In this context, we are going to calculate certain ratios. We called it as a capital structure ratios or a leverage ratios, which is nothing but which focuses on the long-term solvency of the firm. The long-term solvency reflects its ability to meet its long-term commitments such as payments of interest periodically without fail, repayment of principal amounts as well as the amount due. So these are the set of capital structure ratios that are displayed on the screen here, which we'll be learning in our further discussion. The first one is debt equity ratio, interest coverage ratio, ratio of proprietor funds to total assets, and this is again subclassified into two categories. One is ratio of fixed assets to proprietors funds and ratio of current assets to proprietors funds. Debt equity ratio. It is a ratio between outsiders funds, that is the debt raised from the outsiders or the investors, and to that of the insiders funds, that is equity funds. This is used to measure the firm's obligation to creditors in relation to the owner's funds. It is a measure of solvency, and the yardstick for this ratio is the debt equity ratio should be 1:1. That is the standard ratio the company has to maintain. So debt equity ratio is equal to, this is the formula used to calculate the debt equity ratio, is equal to debt divided by equity, or else it can also be written as the outsiders funds divided by the insiders or shareholders funds. Debt or outsiders funds includes debentures, bonds, long-term loans, and so on. Whereas shareholders funds or equity here includes share capital, both preference and equity share capital, reserves, both general and specific, retained earnings, and such other related things. So equity does not only mean equity share, it does not only mean equity share capital, but here it is interpreted as the insiders funds. Equity can also be referred as an insiders funds. Debt here means only long-term debts, not short-term debts. So here is the data given for us we'll use it in order to calculate the debt equity ratio. So debt equity ratio will be focusing on the long-term debts that are applicable, that are a part of the company, as well as its shareholders' equity or else insiders' fund. So in this problem, in this data, the debt equity ratio is equity or a long-term debt divided by shareholders' funds. Divided by shareholders' funds. Right? So from this data, we need to identify the items which fall under the long-term debts. Here it is debenture capital, debenture value, that is 10% debentures, that is the 10% interest payable on this. Loan from bank is standing at 3,50,000. So these are the long-term liabilities in the given data for us. So the current liabilities also listed out here, but we are not going to include the current liabilities in assessing the debt equity ratio. So our long-term debts will be both the debentures and the long-term loan, right? And your insiders fund or the shareholders fund will take into consideration the equity share capital, preference share capital, general reserve or a specific reserve if it is given to us as securities premium, as well as profit and loss balances. These are all the items which fall under the insiders funds. So these are all the items which included for the calculation of the shareholders fund or insiders fund. So it is amounting to rupees 6,54,000, whereas long-term debts is amounting to the tune of rupees 8 lakhs. 6,40,000 is a shareholders funds and 8 lakhs is a long-term debt. So inserting in the formula, substituting in the formula, the resulting value, the ratio is 1.25:1. But the standard ratio that has to be maintained is 1:1. So the ratio what is being calculated is meeting the standards here. So interest coverage ratio. Interest coverage ratio is the next type of ratio under the leverage ratios. Is calculated to judge the firm's capacity to pay the interest on debt it borrows. It is an important ratio for the financial institutions to judge the ability of the borrower to serve the loan from the current year's profits. The higher the ratio, better it is. That is, it indicates the company has no problem in paying the interest. So the formula for calculating the interest coverage ratio is interest and taxes divided by fixed interest charges, or else it can also be, this part can also be written as net profit before interest and taxes, or it can also be referred as EBIT, that is earnings before interest and taxes. So it is interest coverage ratio is equal to EBIT divided by fixed interest charges that are to be paid by the firm, right? The more the number of times coverage, better is the solvency position of the borrower. So there's a small problem here the earnings before interest and taxes, that is EBIT of a company, is 5,60,000. And commitments includes payment of fixed commitments, includes payment of 10% interest on 7,000 debentures of rupees 100 each. It is subjected to tax of 30% per annum. So from this data, we are supposed to calculate the interest coverage ratio. So the fixed interest charges, first calculate the first fixed interest charges it is supposed to pay. That is nothing but 10% on the debentures value. So debentures are 7,000, per rate per debenture is 100. It is mounting to 7 lakhs into 10%. So the fixed interest charges the firm has to meet for that particular financial year is 70,000. So interest coverage ratio is interest before interest and taxes, that is EBIT, earnings before interest and taxes, divided by fixed interest charges. It is calculated and the resulting value is 8 times. So this is an indication, the interpretation of this particular value, that is a result what we have come across is the interest coverage ratio is 8 times. That means that the net profit earnings are 8 times more than the fixed interest charges payable during the year. So the more the number of the times the coverage, the safer is the investment. Now the next type of ratios, that is the next category of ratios under the leverage ratio, is ratio of proprietary funds to total assets. Now total assets is nothing but it includes, it is a sum of tangible fixed assets as well as the current assets. So the standard ratio of proprietors funds to total assets should be 0.5:1, or 50% is considered as the minimum desirable standard that has to be maintained. So ratio of proprietors funds to total assets is calculated using the formula, that is proprietors funds divided by total assets into 100. So small problem, we are going to substitute all the values in the given in the just mentioned formula to assess the proprietors fund ratio of proprietors funds to the total assets. So company XYZ has the following details: proprietors funds to shareholders equity is 10 lakhs, total assets is 25 lakhs. So the ratio of proprietors funds to total assets ratio is proprietors funds divided by total assets into 100. So the calculated the resulting value is 40%. This means that 40% of the company's assets are financed by the owner's equity or the proprietor's fund, and the remaining 60% is financed by the debts or the borrowings made from outside borrowers. Ratio of fixed assets to proprietors funds. As we just now learned, total assets includes both fixed assets as well as the current assets. So separately we are going to find the ratio to the proprietors funds, fixed assets to proprietors funds as well as the current assets to proprietors funds. This ratio explains whether the fixed assets have been brought from the proprietors fund or not. It is not safe to use short-term finances to buy long-term assets, because when the borrowings is to be repaid, there may be a problem, as fixed assets cannot be readily converted into cash. That is a major problem which may lead a company to bankruptcy. So ratio of fixed assets to proprietors funds is fixed assets divided by the proprietors funds into 100. So ABC company has the following details: fixed assets is 12 lakhs, proprietors funds or owner's equity is 15 lakhs. So when substituting the values in the formula, we are getting 80%. So higher the ratio indicates that a larger portion of the owner's equity is being used to acquire fixed assets without relying upon the borrowings or the loans from the outsiders. current ratio of current assets to proprietors funds. A higher ratio of current assets to proprietors funds is considered as a financial strength to the business. It is necessary to hold adequate funds in working capital to generate profits. The working capital is a capital which is used for your day-to-day operational to meet your day-to-day operational expenses in running the business. The ratio of current assets to proprietors funds, this is a formula, current assets divided by proprietors funds into 100. We'll solve a small problem here relating to the above concept. That is, a company XYZ has the following details. Current assets is this one, proprietors fund is this. Calculate the ratio of current assets to proprietors funds. So the calculated value, when substituting the relevant figures here, the resulting value is 66.67%. The higher ratio indicates the larger portion of owners' equity is invested in current assets, suggesting that a company is more liquid and can meet its short-term obligations more easily by converting these current assets into cash within a shorter period of time and meeting the commitments. With this, I'll end up the session here. Thank you.